Well, it's 2017, and the markets keep tantalizing investors with hopes of ever-growing record highs. The Dow has risen more than 8%, and the S&P is up over 6% just since November 8th, and there's all this talk about forward momentum that could propel the markets even higher from here. But there's one thing that we can all be sure of. Bull markets don't last forever, and when they end, people start to panic, everyone starts to sell, and this downward momentum has a devastating effect on the markets as a whole. What I'm describing here is the herd mentality. As soon as investors jump on an upward trend, the momentum keeps feeding on itself until it can no longer support itself, and then the whole thing comes tumbling down. If there's one thing the markets always give us, it's volatility. Since 1928, here's what we've seen on average. 5% losses 3 times a year, 10% losses once a year, 15% losses once every 2 years, and 20% losses every 3 to 4 years. Whether the next downturn that comes along is a correction, a bear market, or even a crash, nobody knows. But the best thing that you can do is to understand that markets will eventually go down and that you cannot control when or why. Those that get hurt the most are often not the diversified investors, but rather those who chase returns. This is where you need to have a strategy. There's been a lot of talk lately about just investing in the S&P 500, the large cap stocks. So let's take a look at that approach. According to this periodic chart of asset class returns, many times the best performing asset classes one year turn out to be the worst in subsequent years, while asset allocation tends to perform consistently in the middle over time. Over the last 15 years, those large cap stocks saw an annualized rate of return of 6.7% with 15.9% volatility. Now, we compare that to an asset allocation portfolio with globally diversified mix of large cap, small cap, international, and bonds. Here, over the same time period, we see an annualized rate of return of 6.9% with 11% volatility. Basically, better returns with a lot less volatility. So here's the bottom line. The numbers show that over the past 15 years, asset allocation has outperformed large cap with far less volatility. And this is really important. In cases like that, you're more likely to stay the course and you're less likely to panic when the waters turn rough. Sure, you won't be the best performer every year, but in years like 2005, when you did 8% and large cap did only 4%, or 2008, when the world appeared to be coming to an end and you lost 25% instead of losing 37%, you are probably less likely to sell out of your diversified portfolio and more likely to stay the course. And that is the name of the game.